Start, Delhivery would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. Kindly note that this call is meant for investors and analysts only if they are ready. To discuss the results, I am pleased to welcome Mr. Sahil Barua, the MD and CEO, Mr. Sandeep Barasia, ED and Chief Investor Relations. As a reminder, all participants in only mode and participants can use the raise hand feature to ask any questions post the opening remarks. Thank the management team for providing us the opportunity to host this call, and in which we'll open.
Thank you, Vijay, and the City team for hosting us. Thank you all for joining the sixth earnings call from Delhivery. This evening, just a quick check, Vijay and Apar, that I'm perfectly audible.
Yes, sir. Sahil, you're audible.
Thank you, audible. Great, excellent. Thank you. So, FY2023-24 is our fourth sequential quarter of revenue growth. In terms of quick statistics, we continue to be India's largest integrated business. We delivered 1,930 crores of revenue in quarter one from services, of 11% sequentially from the same quarter last year, and a 4% growth from quarter four of the last financial year. Do bear in mind that in our industry, quarter three are high watermark quarters, and quarter one is sequentially usually our weakest quarter of the year. Despite this, we've actually seen strong revenue growth in Q1. Adjusted EBITDA margin continues to hover at the break-even point. We're at negative 1.3% for this quarter. We've seen strong volume momentum in the express business, with total shipments delivered across our express and heavy parcel business in Q1, which represents a year-on-year growth of 19.2%, at the upper end of our estimate of growth for the industry, which was between 16 to 20%, which I've spoken about last year, and sequentially versus quarter four, a growth of 1.2%. Our LTL business continues to recover strongly, both in terms of volumes and revenues. We've delivered 333,000 tons of freight in quarter one of the financial year last year, and an 8% growth over the previous quarter four, which again typically is a seasonally high quarter. Network continues to be stable. We cover 18,530 pin codes across the country. We continue to have 26,500 plus active customers across our various service lines. Over 50% of our customers, our revenue comes from customers who use more than two of our services, and we continue to operate over 70 of spine infrastructure tree. In terms of quick statistics that present a snapshot of the business, as you can see, pin code reaches remain stable throughout financial 2023 through our own network and our partnerships with FedEx and Aramex. Continue to have 26,500 active customers as of this financial year and operate about 17.5 million square feet of real estate. We've seen some expansion in quarter one, as is normal in our business. Quarter one is the quarter in which we expand infrastructure, both in terms of spine hub and gateway infrastructure and delivery stations in preparation for growth for the rest of the year. Total gateways have expanded to 101 as of quarter one fiscal 24. Automated sort centers remain constant at 24. We've expanded the total number of delivery centers from 2,880 as of quarter four to 3,170. This includes both new delivery stations as well as conversion of partner centers into owned stations. So you can see the partner centers have declined from 1,175 to 1,039. Higher volume centers will continue to be converted into owned centers going forward. We continue to consolidate freight service centers as volumes have gone up. The integration process, which began in quarter one financial 23, we had 237 freight service centers, including post-delivery and spot-on at the time. This has now been consolidated to 128 centers as of quarter one financial 24. And we continue to have a team size which grows from 57,000 people in quarter four to about 60,300 people as of quarter one fiscal 24. Moving on to the next slide, a quick summary of the quarter. As I mentioned, in the express business, we've seen steady shipment volume growth in what is a seasonally weak quarter. We've seen 19% growth in volumes year on year in express and heavy put together at about 182 million shipments for the quarter. In PTM, strong growth momentum has continued in Q1. The market has obviously now grown 43% a year, so this represents significant share gain for delivery. We've also seen 8% growth over a seasonally strong Q4. This is on the back of service levels that continue to be consistently robust. Those service levels continue to be above 90%, despite the impact of rain and other disruptions. And we continue to improve margins in the PTL business through price revisions and actively churning out lower margin customers. In the supply chain services business, we won new mandates with a number of marquee clients, which we expect to start reflecting in financials in subsequent quarters. This includes Havells, Tata Motors, Mama Earth, and a number of other customers. Over 50% of our outsourced fleet in mid-mile is now sourced through our Orion truckload platform, an initiative that we launched around Q3 of the last financial year. And going forward, we expect to launch intracity sourcing on the Orion platform as well. On the OS1 platform side, we launched Dispatch One, which is our first SaaS product now, which we expect to start rolling out to customers starting Q3 across India and abroad. We've also consummated an investment in Vinculum, which is aimed at expanding value-added services, which is an integrated fulfillment stack for D2C customers across the country. So that's a quick snapshot of the quarter. Moving on, in terms of overall financials, in Q1, we've grown from 1,860 crores of revenue in Q4 to 1,930 crores, which represents a 4% growth quarter-on-quarter and 11% year-on-year. Growth has been delivered both in the express business and in the truckload business, as you can see on the right. The express business has grown to 1,202 crores of revenue, which is a 14% growth compared to the same quarter last year. And shipment volumes have grown from 152 million shipments for the same quarter last year to 182 million shipments in Q1, which is a 19% growth year-on-year. On the PTL side, Q1 last year, of course, was affected by integration issues with Spotr. We've grown revenues since by 34% from 259 crores to 347 crores, and overall volumes from 239 crores to 343 crores, which represents a 44% growth in volumes and 8% over the previous quarter. The other businesses have performed well as well. The truckload business has grown from 109 crores in Q4 financial 23 by 20% to 131 crores in Q1 financial 24, which is also 7% growth over the same quarter last year. Supply chain services has grown 10% from the previous quarter from 188 crores to 206 crores. Though compared to the same period last year, we've seen a decline. This is driven by the underperformance of one of our accounts, which has been affected by low offtake of consumer durables in Q1. Cross-border services has degrown from 57 crores in Q4 to 42 crores in Q1. This is largely driven by a change in mix in the business, as more of our business continues to come from our ocean freight business as opposed to our air freight business, and as yields on both air and ocean freight continue to compress. In terms of adjusted EBITDA, Q1 financial 24 stands at negative 1.3%, which is the bar on the extreme right. Q1, as you can see, over the last two financial years and prior to this, is seasonally our weakest quarter of the year. So the good news is that overall our performance in Q1 relative to both financial 22 and financial 23 has improved significantly. In financial 22, Q1 adjusted EBITDA was a negative 3.8%. Last year in the same quarter we were at negative 12.5%. This year we're at negative 1.3%. Moving on. In terms of an overall breakup in stable, as you can see, revenues in Q1 came in at 1,930 crores. Overall EBITDA from services came in at 196 crores or 10.2% of revenue compared to negative 0.3% for the same quarter last year and 11% in Q4, despite the fact that we've been expanding the network in Q1. Corporate overheads stood at 221 crores, largely driven by inflation in wages and an increase in some fixed costs of the network. As a percentage of revenue, they grew from 10.7% to 11.4%, and net adjusted EBITDA therefore came in at negative 25 crores or negative 1.3%. The next slide, yeah. Q4 financial, this is the EBITDA bridge that we present every quarter. Q4 financial 23 adjusted EBITDA stood at 6 crores. Our incremental revenue from Q4 to Q1 stood at 44 crores. And incremental gross profit in the transport business stood at 17 crores prior to certain specific items for Q1. We had about 4 crores of annual wage increments above the gross margin line, which is at the operational staff levels. We have planned investments in the last mile, which is the expansion of the delivery station network, which led to an increase of 2 crores and an impact of unfavorable factors, which are linked to both security concerns in Manipur and the weather impact in North India in the second half of the quarter, which led to a decline of 4 crores. So the total increase in transport gross profit after adjusting for these stands of 7 crores. Transport fixed costs have increased by 13 crores, which is driven by an increase in mid-mile capacity, both in terms of gateway and hub infrastructure and in terms of the trucking network, and annual wage increases of supervisory employees, which is typically done in quarter 1 of the financial year. And we've seen a total decrease in transport service EBITDA therefore of 6 crores. Following this, there's an increase in service EBITDA, there's a reduction in service EBITDA of the non-transport businesses by 3 crores, largely driven by the supply chain services business. And secondly, an increase in corporate costs of about 21 crores, which is driven by increments in salaries of 6 crores, a one-time milestone-based payout to employees of TRI Robotics, which is a company that we acquired in financial 22 of 5 crores. Investments in our marketing program, which have begun this financial year, of about 3 crores, and provisioning for ongoing commercial disputes with certain members, in this case Go Ahead, of about 2 crores, which leads to a total change of negative 30 crores and leads to quarter 1 financial 24 adjusted EBITDA of negative 25 crores. In terms of key cost drivers, as you can see, not very significant change between quarter 4 fiscal 23 and quarter 1 fiscal 24. Total freight handling and servicing costs have increased from 1372 crores to 1438 crores, which on an absolute basis continues to be below the same cost at the same time last year in quarter 1, which was 1453 crores. As a percentage of revenue from services, freight handling and servicing therefore is reduced from 83.2% last year to 74.5% as of quarter 1 fiscal 24. The major changes, one has been in vehicle rental expenses, which have reduced from 20.6% to 20.1%. We expect this to improve further as we continue to source intracity vehicles through our Orion platform. Contractual manpower expenses have increased from 11.1% temporarily to 12.1%. This is due to the impact of rains due to us continuing to pay salaries in states that have been affected by security reasons and annual wage increases. However, the net change otherwise is in lost shipment expenses, which continues to improve from 3.2% in quarter 1 financial 23 to 1.7% in the previous quarter to 1.3% in this quarter. Moving on, this is the final adjusted EBITDA bridge. Total revenue from customers, as I mentioned, stood at 1930 crores. Freight handling and servicing costs stood at 1438 crores. Employee benefit expenses of 353 crores. And other expenses at 152 crores, leading to a reported EBITDA of negative 13 crores. Adjusting for share-based payment expenses and capitalization of the leases, this leads to our overall adjusted EBITDA of negative 25 crores, or minus 1.3% of that. So to summarize the quarter, this is our 4th sequential quarter of revenue growth since quarter 1 of last year. Express and LTL businesses have demonstrated revenue growth and volume growth have borne fruit in quarter 1. We've expanded mid-mile capacity volumes in Q2, Q3, and Q4. Margins remain stable broadly overall, and we expect a great financial year ahead. With that, I'll pause and happy to take questions.
Thank you, Sahil. Just a reminder to participants, if you have any questions, please raise your hands and the operator will take them up. Thank you.
Yes, Sachin, you may ask your question now.
Sure. Congrats, Sahil and team on having a great quarter. I had a couple of questions, basically. So on PTL, we have been highlighting a weekly sort of trending in the past couple of quarters. I understand this was done due to spot-on acquisition, sort of integration issues getting over, and to reflect how we are ramping up. We do not see that happening this quarter. Do we assume that the growth in spot-on sort of PTL business has normalized now, or there is something else going on?
Not at all, Sachin. I think the point of demonstrating it in the past was really because there were several questions about the PTL business, and we felt it was necessary to demonstrate the ramp-up of volumes. As you can see, we had a very strong start to the FY. We've seen an 8% growth in volume in quarter one over the previous quarter already, and compared to last year of 44% in overall volumes. And the idea was really simply at this point to say, look, integration issues are behind us, and going forward, we expect the trend of growth in PTL to continue. So we don't really need to demonstrate weekly volumes any further.
Understood. Quickly on the employee expense side, that's the second question. So I noticed that while our sort of employee expenses are going up very, very mutedly in terms of rising, but we see ESOPs being granted at a rapid pace, right? So in Q1, if I calculate quickly from the filings, roughly that amounts to 80 CR worth of ESOPs being granted. Is that how we should look at in the sense like ESOP should grow, employees' expenses in terms of cash being relatively muted?
Yeah, I think we granted 2 million ESOPs as part of our annual performance cycle. Our annual performance cycle takes place at the end of quarter 4, and so the grants are made at the start of quarter 1. And then after that, we don't have too many grants which happen through the year except for some exceptional performance. So you're right, you will see ESOP expenses in quarter 1. Our policy is as per our performance policy. Wage increments, typically in our case, we forecast at being usually between 6 to 8% annually. But overall, you should not expect to see significant wage inflation year on year going forward.
Understood. Thanks. And just one final thing, right? I hope the violence in Gurgaon and the surroundings is not impacting business, or can you give some color on that?
Certainly. I think the reality is that both weather and security situations do disrupt operations in various ways. We haven't fortunately seen any significant impact on our operations with the shutdown of internet. Even briefly, we had to modify how we were picking up and delivering consignments. We continued to remain operational throughout. We also managed to continue to remain operational throughout in all rain-affected areas throughout the end of quarter 1. So no major impact per se. We remained operational despite the internet connections. We've continued to pick up volumes overall. But we monitor the situation. On 2 days, of course, where in particularly sort of violence-prone areas, we did have to suspend delivery operations briefly.
Understood. Thanks so much, and all the best for the year ahead.
Thank you.
Next question for Sachin Sargamkar.
Hi, thank you for the opportunity. I have 3 questions. First question, Sahil and team, just wanted to understand about what's happening on the ground on e-commerce as well as let's say from other operators like social commerce and D2C. Reason I'm asking is your shipment growth for 1Q was great, and just wanted to understand, should we look at this as a trend to continue, and are we seeing improvement in the overall general appetite out there?
Sure, Sachin. In general, these days I'm quite careful when I'm making statements about the e-commerce market. But that said, I think, look, our volume growth has been solid in this quarter. We've been at 182 million shipments overall compared to 152 last year. I think if you remember, our position has consistently been that while the medium and long-term trajectory for e-commerce is consistent, we expect the market to grow between, call it 16 and 20%. And our growth has been at the upper end of that. Our assessment is that represents an overall share gain in the market. In terms of market volumes, quarter 1 is historically not a very strong quarter for e-commerce. In general, quarter 2 is when the action starts picking up about now, and volumes then continue through quarter 3 and quarter 4. So we expect that hopefully there'll be sort of solid volume growth in August, and then with the Diwali sales at end of year. In terms of B2C, that's a particular segment of focus. I think we've gained significant share in the B2C market. Overall, we've been focusing on our value proposition for B2C, both increasing speed, integrating fulfillment, and launching a suite of data services, which a number of customers have now started taking up. And we've also been growing our presence with smaller and the long tail of e-commerce really, both with the launch of Delhivery One, which is a self-serve portal which allows small brands to really sort of access our services seamlessly, and also through the growth of our franchise network and the growth of our Delhivery C2C shipping app, which allows the extreme long tail to start shipping through delivery immediately without sort of the burdens of long contract process and a long sort of integration process. So that's sort of been a secret to our growth in quarter one. I think we are optimistic about e-commerce as usual. Individual players, as I mentioned, and I think as this public continue to face their sort of independent struggles and their independent strategy continues to evolve. But for us, we maintain consistent market share with the larger players. We gain share with the smaller players. We continue to launch value-added services. And so irrespective of market outcomes, I think we are well positioned.
Thanks, Sal. So does that mean you guys are seeing a mix shift more in D2C versus e-commerce in this seasonally slower quarter 1Q for e-commerce?
We've certainly seen a shift in terms of client concentration. So our sort of top 5 client concentration has reduced overall. And both D2C, the definition of D2C is a little bit vague, but I'd say, sort of vertical e-commerce plus D2C plus SME is now a larger percentage of our business.
Thanks. My second question is on the supply chain business. And, historically, when we look at the growth, the trends look a bit volatile. Case in point, this quarter, we had a minus 13% YOY growth or a 10% QOQ growth. So just wanted to get a bit more color from you in terms of understanding what's going on here. And, we heard the comments in the opening mark being a bit more marquee customers. Question out here is, should we see a stabilization of the trend out here, or any color you could provide us in terms of how to look at this business?
Well, I think as far as this business goes, Sachin, one of the things that we've spoken about is that the minimum size of this business actually is the sort of where it stabilizes is much larger than where we are. This is still sort of an early business for delivery. We have these are typically large contracts that will be anywhere from 20-30 crores a year at the minimum up to nearly 150 crores a year. And so when individuals there sort of moments in the year that can affect growth both upwards positively and negatively for us right now. I think there were disruptions in supply chain in general in quarter one when you consider the security situation, the rains, and sort of how it's affected consumption, and that's reflected a little bit in our numbers. The contracts that I pointed out, whether it's Harvard or Tata Motors or Mama or some of the others that are starting up, these are ones that we expect will begin in quarter 3, quarter 4. We've signed these contracts and now we start deploying and building the infrastructure, which typically takes anywhere from about 60 to 90 days. So hopefully this will hit us in quarter 3 and quarter 4. But this business will continue to sort of, grow fast off of this base and see some volatility for the near future.
Thanks, Sal. Very clear. And third question perhaps to Amit. Amit, just wanted to understand what's happening in depreciation as well as other income. Depreciation was down 31%. Same for other income. Is it all treasury income or something else out here?
So on the depreciation, there are 2 components. One related to depreciation of fixed assets. As you are aware that we basically build most of the capacity in first half of the fiscal year. So quarter 3 and quarter 4 typically see relatively lower investments. And as a result, the implication of lower WDV-based depreciation is evident in the quarter 1 subsequently. So that is one of the reasons why depreciation and amortization, depreciation was lower. I think this number would tune to about 25 odd crore attributable to this. And on the amortization, in quarter 4 of FY23, we amortized fully the spot-on IT systems which we know.
The market has not come down, so it's a mixed issue. Can you just talk about that?
Largely a mixed issue, Hitesh. So it's a combination of both the client mix changing in the express parcel business, the salience of the heavy business as it changes. There is basically quarter on quarter there may be variations in the overall yield, and also the zone mix. Typically in quarter 3 is when we see a bump up in realization both because the salience of the heavy business can go up and slightly heavier products get shipped out in quarter 3. But per se, no change overall in pricing strategy between quarter 4 and quarter 1. So on the express side, what you're seeing is really just a shift in mix to some extent.
And how? Sorry. Go ahead. You're saying something.
No, I was just going to ask the same question for PTL. Same thing on PTL. As I mentioned, it's a mix shift. In PTL, we sort of have categories of customers. One is major accounts or enterprise customers. The second is SMEs, and the third is sort of retail and aggregator customers. And the mix across the three varies. There's a natural variance that sort of occurs in the overall yield. And outside of which, for specific customers, there are provisions that we take which can affect the yield in any given quarter, but no change in pricing strategy.
Sure. And then other two questions. First is also on the network utilization. So how is it increased or decreased as you have set up more infrastructure over Q-on-Q basis?
Network utilization in quarter 1 is obviously slightly lower than network utilization in quarter 4 because we've expanded at an overall level, because we've expanded mid-mile facilities in preparation for the rest of the year. And obviously we've increased the overall count of delivery stations also in preparation for the rest of the year. So utilization will drop a little bit to that extent. That said, at an aggregate level, network utilization doesn't really have any meaning because it's ultimately just an aggregate of utilization at each individual facility level. What I can tell you is that facility level utilizations for us in the mid-mile will typically vary anywhere from about 70% at the lower end to up to about 110% in various locations. And the delivery stations on average, my sense is that we are at this point probably close to about 60 to 65% utilized.
Okay. And you touch base bound on the PTL mix, right? So just want to get more sense on this. So what is your mix between enterprise, SME and retail? And when I compare the yield of other players in the market, the yield is much higher because I think the mix is also different because they're more towards SME or retail. So can you shed some light on it? How should we look at it? Because we are closely monitoring the yields to understand the profitability in the PTL business. Is that the right way to look at it?
It really depends. I mean, I can't really comment on what drives the yield for other players in the market. The way at least we look at it internally is our yield is determined by our own unit economics and our own targets in terms of gross margins and EBITDA margins. We do have obviously different pricing strategy for enterprise customers versus SMEs versus retail. And obviously the pricing strategy generally will be that the larger the customer, sort of marginally there are discounts on price. So retail will typically be highest yield, followed by SME, followed by major accounts. In terms of the mix, look, the reason I don't want to one is we don't disclose overall mix. And the second is at this point, providing an exact breakup of mix is not a good indication of the future because our ambition is not to grow at 5% a year. Our ambition ultimately is there's a $3 billion, $5 billion LTL market, and delivery at this point in time, all things said and done, we're a $200 to $50 million player. So there's a long way to go. Our ambition will be to gain share across all segments. We do not have a yield protection strategy. We have a growth strategy and a margin improvement strategy. And therefore, I don't think that our yield will remain absolutely predictable going forward.
Okay, great. Thanks, Sahil, and all the best.
Thank you.
Next question we have for Pulkit Patni.
Strategy and not yield. I think it partly answers. Maybe just an extension of that 22, your realization on the PTL business was close to 11,000, which has come down to 9,900 right now. And this is happening at a time when you said that, you are taking out some of the low yield customers. So any rough math as to at what yield level do we think we bottom out in the sense that we can't go below that? Any numbers that you have, based on the cost initiatives that you are undertaking?
Look, I think let's not confuse profitability and yield because it is possible to be profitable. Let me give you an example. If you pick up a, LTL freight in the city of Delhi and you're delivering LTL freight in Faridabad, the yield is naturally significantly lower than if you're picking it up in Delhi and delivering it in Cochin. And so, the overall yield that you have is a reflection of the mix of your business. So we don't frankly waste a lot of time comparing our yield to any of our other competitors. We have yield targets that we need to reach for every single load that we carry. And we have those systems which allow us to price every single load accurately. Typically players in this space have relied on sort of rule of thumb guidelines for yield, whereas we tend to take what we think is a more scientific and strategic sort of look at how to price for every load. So as we have called low margin customers, that may or may not have any sort of implication in terms of yield remaining stable, going down or going up. You can have unprofitable customers at all yield points. So, that's sort of, I don't know if that answers your question, but we don't really, there's no minimum yield also at an aggregated level that makes any sense. If it's a intracity load, typically you would argue that sort of the minimum yield you require is about 5 rupees of consignment, and then of course it varies depending on the distance that you're traveling.
Sure. So effectively from 11,000 to 9,900, it's really not any discounts on rural customer. It's just the mix that has been changing through this period, or things like distance, etc.
Absolutely.
Okay. Thank you.
Next question we have for Baiju Joshi.
Hi, am I audible?
Yeah, hi. Baiju, yes.
Yes. Thank you. Thank you for the opportunity. I have two questions on behalf of Aditya Suresh, if I may. First question is on the small disruptions. Like last year there were rains, and then again this year there were a couple of incidents. So just wanted to understand what steps you can take at your end to tackle such disruptions so that you can cascade into bigger issues.
It's a good question. We've called out before that one of the big macro risks that faces the company is disruptions through weather. At our end, of course, we have a fairly rigorous process of making sure that our infrastructure, the spine infrastructure, is resistant to all forms of natural calamities, including rain. So our facilities are designed as such, right, from vehicle ingress to parking to making sure we have staff which is available and taken care of, for health and safety measures. So we've seen per se no major disruption in our spine network in terms of the ability to service our customers. That said, customers obviously do face disruptions in their operations when it's raining heavily, and as a consequence of that, sometimes that may lead to idle operations may be shut. There's limited sort of control that we have on that. But if your question is the network managed to be resistant to rain, the answer is yes.
Yes, thank you. And secondly, can you provide any update on the ONDC network and any use cases that have seen considerable traction in terms of volumes?
We're not yet significant participants on the ONDC network. I think ONDC has seen some traction, especially on the food side. I'm not aware of sort of what the most recent numbers are, but the last I heard, numbers were in the range of weekend orders of food were in the range of some 30,000-40,000 orders a day. Look, whenever ONDC plays out, we will be meaningful participants as required. I think we like the idea that we have the ability to publish a price and a service level, sort of the underlying cost advantage to service any demand on ONDC. We are integrated. We continue to watch it, but at this point we are not active participants.
Understood. Thank you very much.
Next question we have for Ankita Shah.
Hello. Yeah. Can you hear me?
Yes, Ankita, please go ahead.
Hi. Sir, you shared the approximate utilization level on the mid-mile side, but on the first and last mile, would it be possible for you to give some color on the utilization side?
Yeah, utilization on the last mile, as I mentioned, Ankita, is in the range of about 6 of theoretical capacity. That said, even in the mid-mile and in the last mile, I do want to point out that one of the jobs that our engineering teams perform is to continuously figure out how we can release additional capacity. So the 110% in the mid-mile also that I pointed out, the reality is that we probably have the ability to go to 120, 125% with engineering, which we continue to explore. So like I said, I wouldn't read too much into aggregate utilizations across the network at this point in time. The way I would put it is there's operating leverage in the business which is quite evident. I think we've spoken about it multiple times over the last several quarters. And the second is that, as you're aware, at the gross margin level, our unit economics continue to be highly positive. And so overall, as utilization, even if it stays flat, volume growth should deliver returns to us. And if we continue to sort of see these, engineering opportunities to increase productivity, we'll see an improvement in margins. But there is a reason we do not publish aggregate network utilization. I'm aware that other players in the industry once in a while do provide this estimate, but in our view, providing a network level utilization actually is dangerous and false.
Okay. Secondly, just one clarification. Is there a change in the number of 1Q23, same quarter last year, volume numbers of PTL business? Because I think we've published 239,000 this quarter, and the earlier presentation was mentioning 262,000 tons. So, just wanted to clarify, or I can pick it offline if at all.
Comments to just investigate and come back to you, but per se there's no change.
Okay, I'll get that checked. Secondly, last question from my side. So, last 2-3 years, if I look at the annual numbers, there was a increase in the lost shipments number. I have seen on a quarter-on-quarter basis for 1Q this has come down, but on a full year basis, any outlook on where this number can be on a yearly basis, full year FY24?
So as you can see, the total loss in damage expense as a percentage of revenue is at 1.3% in this quarter. We did see a spike in quarter one when we had integration issues, and this was more reconciliation sort of related loss and damages that we had to bear in quarter one. On a normalized basis, our expectation is that loss and damage should be sub 1% of revenue, and that's the internal target that we're working towards.
Thank you.
Next question we have from Srinidhi.
Yeah, hi. I'm audible.
Yeah, hi Srinidhi, go ahead.
Yeah, hi Sahil. Thank you. Congratulations on good set of numbers. Sahil, I want to understand on the operational strategy wherein we're basically integrating mid-mile operation of express business and PTL business. In that context, does company have to be very selective from the PTL customers?
I think irrespective of our strategy of integration, we have to be selective about the kinds of loads that we pick from customers. Our view has been very simple, which is that we look for loads fundamentally. Let me put it this way, we do not do loads that are not easily transportable. So as an example, we don't do over-dimensional cargo, we don't do hazardous material, we don't do improperly packaged material or loosely packaged material in the PTL network at all. It's a fairly tightly controlled sort of form factor, and we don't do loads where a single piece weight is higher than 400 kilograms.
But these are like more of a specialized cargo, right? Rest of the market itself should be very large, which could be integratable, right?
Absolutely.
Okay. And does the load characteristics also matter? Like if it is very seasonal, your network can't handle it. And is the load coming from smaller customers? Do you have more of a marketing bandwidth to handle it, or it doesn't matter whether a customer is small or the load profile to the seasonality is very different?
The whole point of delivery is that essentially we are able to service any size of customer with any form of load that fits our requirements. As I mentioned, there is a small set of things that we don't do, but outside of that, irrespective of a customer's seasonal requirements or a customer's sort of size, we provide exactly the same service. In fact, we not only provide it's not only our ability to serve, our aim really is to be the lowest cost service provider for absolutely any size of customer and to be the highest quality service provider to any size of customers. So we do not differentiate in terms of either, sort of saying we can't handle your loads because of seasonality or we can't handle your loads because you're a small customer or anything of the sort. Our entire network is designed to service everyone.
Yeah, thank you, Sahil. And one more, if I may. In one of the presentation deck, you highlighted of incremental investment in marketing. It is directed more to adding SME customers in the PTL business, with your network getting stabilized and service level back to the level you want?
That's exactly correct. We have no particular need to perform marketing for our e-commerce business. We're already the market leader. and I think we're more or less the default choice for anyone. And on the PTL side, I think what we're doing is expanding our local presence across tier 2 and tier 3 markets across the country.
Thank you, sir. Those are my questions. All the best.
Thank you very much.
Next question we have for Aditya Mungia.
Hi everyone. I think the first question that I had was more on the adjusted EBITDA margins that we reported in the first quarter. Right. Now I see this is a 200 basis points improvement to FY22. What I wanted to understand was that should we assume that FY22 was a good reflection of seasonality across quarters, and thus the full year FY24 numbers should be 200 basis points higher, and probably even more so given the cost improvements that have happened in the space?
So I would say you're breaking up a little bit, but I think I got the gist of your question. I think, far be it for me to suggest what you should or should not assume. But broadly, what I can certainly tell you is that yes, our margins in FY24 are 200 basis points better than they were in fiscal 22, on a larger network as well, and on lower realizations. So that should give you a sense of sort of the operating leverage in the business. I do think there are certain structural factors in fiscal 24 which are better than fiscal 22. One is sorry, go ahead.
The second question that I had was can you hear me?
Yeah, which I can hear you, but I think you missed my answer, which is fine. So why don't you go ahead?
Yes, if you can hear me well, the question that I had was more on the recent announcement by Flipkart to enter the express B2B space. The question that I had was, do you think that given the benefits of being inside express B2B as a synergistic step along with B2C, these kind of strategic actions would happen more and more by almost all e-commerce players? And obviously, if that is the case, does that make us more worried about us kind of retaining this competitive advantage over time?
Aditya, can you hear me? Just checking.
I can hear you.
I'll ask the question, but I think there's some background noise, so maybe you can... Yeah, okay. I think Aditya's question was essentially, are we worried about the fact that Flipkart has decided to get into B2B logistics? The short answer to this is no, and fundamentally for a couple of reasons. One, very, very simply, is that fundamentally the PTL model that you require to establish, it needs to have a distributed network of our kind, which in our belief, self-networks do not have. And so their ability to scale up their B2B businesses is uncertain. The second is, I don't see any strategic advantage or strategic rationale for captives to be in this business at all. First of all, it doesn't make any sense for a captive whose job is to provide theoretically a higher customer experience to the e-commerce brand going out and, let's say, delivering spare parts for Tata Motors to their dealers. I mean, I don't understand what the logic for that is at all, and how this is capital efficient whatsoever. So there's a strategic misalignment, there's an economic misalignment. The announcement is the easiest part of setting up a business. So the rest of it we'll see. But let's say if your question is, are we worried? The short answer is no. We have the infrastructure, we have the capability, we have the team, and we have the economics to continue to grow in this market, irrespective of individual strategies by the captives.
Just a last question from my side. Your focus adjusted EBITDA numbers for FY22, which were 3.5% on the positive side, were they stable numbers for a fourth quarter, or did they have any Shopee scale-up driven?
Yeah, if you were to look at quarter three was also positive when the influence of Shopee was not as large. So yes, there was some impact from Shopee, but it was not as significant perhaps as you think. Outside of which, as I mentioned, there are structural factors in our business in this financial year which are different from where we were in financial 22. We have larger, higher scale hubs which are more automated, higher productivities, and we also have a significantly more developed trucking network, and we've also been jettisoning low margin customers. So let us see as the business plays out. Financial 22 was a good indication of how operating leverage in our business plays out. But neither financial 22 nor financial 24 is going to reflect exactly what the long-term economics of the business are going to look like.
Thank you for those answers. Those are my questions.
Thank you.
Next question we have from Rishabh Pare.
Hi, can you hear me?
Yes, please go ahead, Rishabh.
Sir, just one question on our, incrementally we've guided that our gross margin will be 50% of our incremental transport revenue. This quarter is about 38%. So what would you attribute that to? And going forward, do you think we can hit the 50% mark over the next 3-4 quarters? Thanks.
Thanks, Rishabh. Yeah, that's a good point. I think we would probably have ended up at the 50% mark in any case. I think there was some volatility which came from weather towards the end. One of the things it does is it reduces last mile productivity to some extent because the number of deliveries per person comes down, obviously because of the impact of the rains. That's one of the reasons why incremental gross margins in this quarter look a little softer than they have in the past. How much further will the 50% incremental GMs continue? As I mentioned, this question's been asked quarter on quarter. When we began in quarter 2 last year answering this question, at that point our estimation was that it would last till quarter 4. But we've been pleasantly surprised that incremental GMs have continued to remain high in quarter 4 and in quarter 1. And as of now, I do think that we have sort of capacity in the network, and our engineering is strong enough to allow us to continue to see high incremental gross margins in the near future. Long term, our expectation, of course, when capacity utilization normalizes, is that incremental gross margins will be in the 30 to 35% kind of range. But whether we'll be there exactly sort of in this quarter or the next quarter or the quarter after is not something I can immediately comment on.
Understood. Thank you. Thank you very much.
Next question we have from Naitik Modi.
Hi, thanks for the opportunity. Can you hear me?
Yes, absolutely. Please go ahead, Naitik.
Yeah, Sahil, again, my question on the PTL business. So the incremental business this quarter on quarter has come at a much lower realization. So just wanted some understanding on that.
Yeah, as I mentioned, I think this is a combination. This is a mix impact and also an impact of what lanes we're servicing. As I mentioned, the 3 major segments of the business are major accounts, SME and retail. So one is there's automatically sort of the mix of that, those customers changes. Yield may change a little bit. The second is within those customers, obviously as they expand their relationships with us, it's possible that they're shipping on some lanes which are shorter distance lanes, for instance, therefore affecting yield. I wouldn't look at yield necessarily. Internally, what we look at is gross margin for the PTL business and EBITDA for the PTL business. As long as those are trending upwards, on an absolute and relative basis, we don't have to worry about changes in yield. If your question is, has there been any change in pricing? The answer is no.
Okay, thanks. And on the service EBITDA, we have made about 197. Of that, how much losses would be there in the non-transportation business?
Amit, do you want to take that question?
Can you please repeat the question?
So out of the service EBITDA that we've reported about 197, this consist of what losses from the non-transportation business?
The service EBITDA of non-transportation businesses would put together be almost flat or about like 2 percentage points.
Oh, okay. All right. Fine. Thank you.
Next question we have for Mayur Gatani.
Thank you for the opportunity. I just wanted to check, you mentioned something on the SaaS in the presentation. Maybe I missed it. Can you throw some more light on what that was and what are you referring to? First question. And second was, you've been very confident on the margin front, on the volume front. but the margins have been on the weaker side because you have increments this quarter, you have some one-off expenses for expansion that you're expecting a lot of growth in the second half. So this will continue in quarter two, or this is what you have to do, and now you will see a significant improvement in margins as volumes increase.
Sure. Let me answer the second question quickly because that's a much shorter answer. As you can see, in every year, margins begin to improve in quarter two, and that continues through the financial year. Our wage increments obviously hit us in quarter one, and as I mentioned during the question from Mukesh Saraf, we typically see about 60 to 70% of our planned infrastructure development to happen in quarter one. So no, I don't expect any significant increase in the fixed cost base going forward in Q2, Q3, Q4. We do expect volumes to grow through the rest of the financial year, and so the operating leverage should play out and margins should improve as volume growth kicks in. Obviously, bear in mind that quarter three, quarter four are seasonally high quarters, both for e-commerce as well as for PTL. Coming to your first question on platform and Dispatch One, as I've mentioned multiple times, this one is the platform that we've been building for the last 3.5 years. It's essentially, think of it as building Android for logistics, effectively an operating system which allows logistics operators, enterprises to essentially build their own logistics applications, and also to integrate with the deliveries logistics systems. It's aimed at small-scale operators both in India and the rest of the world. They have the ability to use our first-party applications, which is Dispatch One is one example of that, which we've launched, which allows last-mile operators to essentially use our dispatch service. So it's exactly the same as Delhivery's dispatch service, and they also have the ability to customize it to their specific needs in case they have sort of highly specific product requirements. This is aimed at companies both in India and outside India, so we're going to be targeting both the Middle East and the US as potential customers. We have 10 potential customers that we're speaking to. It will be monetized similar to a standard SaaS product. But that said, this isn't going to be a significant portion of our revenues at all through this year. We're still at an early deployment stage. So first-party software is one part of what we're doing, which is the SaaS product. The second is also allowing other logistics applications to ride on top of our platform. So you will remember that we acquired a company called Algorithm, which provides data services in the supply chain services space. So that will also be deployed on top of our platform stack. And similarly, other, for example, routing applications or scheduling applications can also be deployed on top of the OS1 stack, which will then be available to all of the customers who deliver these services. So that's broadly the platform strategy. This is the first commercial deployment that we're doing. It's on schedule as of now. We don't expect it to form any significant portion of revenue or profits in this year. Hopefully, we'll start seeing monetization slightly more significantly in the next financial.
So, just to understand better, you are saying that you've developed a platform on the delivery basis where third-party logistics company can take it from you and run their own business in India as well as outside.
That's right. They can use both our first-party applications, or they can use components of the platform to build their own logistics applications as well if they happen to have the resources to do so. We provide them the basic libraries, the basic toolkits that they need to do so, and also the configuration layers if they need to do so. So let's say you're a large logistics company, you can use the base components of platform to build your own logistics applications. Let's say you're a small logistics company and you want a first-party dispatch application, we'll provide it to you. Let's say you're a logistics wants to offer your services to customers who are using Delhivery's logistics stack, you can do that as well. So that's broadly what platform is.
Sorry, just to ponder a little bit more on this. So will it be like, why would someone use your software? Because wouldn't it be leading, giving their information, their client information to you?
No. It's similar to how you would use, as an example, AWS. Data jurisdiction is very clear. Delhivery does not have access to proprietary data. This is entirely all of the data belongs to the specific company which is utilizing our services, and we have no access to it.
Okay, and we see a better monetization on numbers coming from FY25 onward. This is just the start.
Yes.
Thank you, and all the very best.
Thank you.
Next question we have from Keshav Bagri.
Hello. Hi, sir. Am I audible?
Yes, Keshav. Please go ahead.
Sai, my question is more from a business perspective. Like we strive to offer the best services at the best price. But don't you think that price should command a premium in the market? And if you're not focusing much on the pricing part of the picture, then how are cost efficiencies lying? Because I think that there's a lot of infrastructure integration which we have done with spot on. So if you could just explain me this.
Certainly, Keshav. It's not necessary that the best product should always be the most expensive product. If that were the case, as an example, cloud computing would have died at the start. The fact is that certain businesses are the plumbing of how other businesses work, and logistics is one of those. If your payment gateway said we are the highest quality payment gateway and therefore you should pay us the highest charges, there'd be no electronic payments. And our view is that logistics is more or less exactly the same. You must remember that ultimately, and we remember, our stated strategy is that we are a cost input to all of our customers. Every dollar that we save our customers is in growing their businesses. And every dollar that they invest in growing their businesses is ultimately a dollar of revenue that comes back to us and allows us to scale further. Delhivery's stated strategy has always been and will always be to be the most efficient and lowest cost provider of services to all of our customers and all of our business lines. In fact, I think the big fallacy in logistics has always been the desire to be a high-price yield management. I think there are specific verticals where that makes sense. If you were delivering vaccines, certainly being a premium player would make sense. If you were running cold chain, perhaps. But what we do fundamentally is high skill and we are cost input to highly cost-sensitive customers, and we therefore have to be the lowest cost service provider.
That was. And my second point would be on the warehousing space. Like, what are we offering there? Because I think Safe Express has released their annual statements and they have touched around 3,000 crore revenue in the express parcels, and they were very bullish about the warehousing space. So I just wanted to understand what is Delhivery proposing in that space.
We provide fulfillment centers both for B2C commerce as well as for B2B. It's essentially an integrated supply chain solution. So let's say you're an e-commerce company or D2C company which requires warehousing space for your inventory across the country. We provide it on a variable basis so that you don't have to invest upfront in the fixed costs of warehousing. We also allow you to distribute your inventory across the country and essentially allow you to create a white labeled Amazon Prime kind of service. On the B2B side, it's an integrated supply chain solution. So essentially we help companies design and execute their supply chains. We both obviously help them store inventory and transport inventory to and from plants and warehouses across the country and then to dealers or to customers. And through algorithm and through Vinculum, we also have the ability to help them optimize inventory placement and fill rates and transport selection. So warehousing obviously is sort of knit into the whole supply chain services and transportation ecosystem.
So continuing my point on business ideology, I just wanted to ask, how far are we from volumes which would help us realize EBITDA level profitability? Because I think we are doing good as far as PTL volumes are concerned. I think we have reached a significant, I would say, stage of saturation of the service levels. So how far are we from the volumes? So could you please just...
Certainly, Keshav. I think if you look at quarter 4, you can see that we had EBITDA breakeven in quarter 4. And so our estimation is that this year we will have quarters where we will break even. So clearly we're not far from volumes being large enough for us to be break even at an adjusted EBITDA level. Our ambition, as I mentioned in the past, is also to be generating net profits by the time we are late financial 25, early financial 26. Over the next couple of quarters though, do bear in mind the market is very large. It's, India is anomalous as a market in terms of the fact that we don't have a single large logistics company. As India's largest integrated service provider, we are, as of last year, we were less than $1 billion in revenue. I think our focus really, first of all, is also to grow in size, which is really to be a $5, $7, $10 billion company in revenue terms. And so in the short term, as we continue to make capacity investments in any single quarter, our adjusted EBITDA margins or PAT margins may be negative if we expand capacity heavily. This is based on our assessment of future growth. But this year again, as we've seen in financial 22 and in financial 23, I think operating leverage will kick in and we will see profitable quarters this year as well.
And my last question would be on the competitive side. I think Marsec has also announced that it is entering the express parcel business with a flat rate of some 80 rupees per parcel and all. Plus, there's a lot of cash on the balance sheet, and I know the proceeds have just begun, like, has just come 18 months back. So how are we planning to use that
Is it more on the acquisition side, or are we going to add more trucks and more physical facilities? So could you please just...
Sure. I think for us, strategically, we've always been clear, which is we will continue to build capacity to service the market, which means expanding our mid-mile facilities, which means expanding our trucking network, continuing to gain scale. And so a portion of the cash that we've raised at the moment will continue to be invested in expanding capacity. We obviously believe that we are a natural consolidator in this market. And, we do look for inorganic opportunities for growth as well. And so, a certain amount of our capital, should we find the right asset at the right price, will be deployed towards acquisitions if required. We made a couple of bolt-on acquisitions on the tech side in any case over the last couple of quarters. And outside of that, some of it, is also ultimately within a volatile and uncertain world. And so it provides a buffer of safety to the company. Having a strong balance sheet, I think, is also a competitive advantage to us. About Maersk, specifically, I can't really comment too much because I have no idea why an ocean freight company wishes to compete in an express parcel market. But I doubt that it's likely to be a very successful strategy, at least in the short to mid-term. It's an entirely new capability for them. And if you ask me, the 80 rupee price point is higher than the price point that players in the market, not just Delhivery, but other players in the market already offer. So I'm not really sure what the value proposition is at all.
Thank you. That is great.
Next, we have Dirish Pata.
Hello, am I audible?
Yeah, hi Dirish, please go ahead.
Hi, thank you for taking my question. This slide which is there on ESOP charge. So this year's comp cycle, if I heard correctly, you said is already over, and this year you gave 2 million ESOPs, right?
That's correct.
Okay. And what was this number last year?
Amit, can you take this question, please?
I'll just pull in the last quarter's results and share.
So my basic question was, where I was getting to was that on a steady state basis, like you share, right? In a steady state, we'll have 30-35% gross margin. So what is the steady state ESOP charge? Because in this table, as of now, FY28 shows 0, right? But as time passes, you have grants being done. So on a steady state basis, what is going to be the ESOP P&L charge?
Yeah. Apart, can you please jump to that slide? So I'll just summarize how our ESOPs are structured. There are two portions of our stock options, performance-based and time-based. Can you go to the previous slide, please? Yeah. The ESOPs which are ungranted today stand at a total of about 39 million stock options, out of which time-based are 24 million stock options, and performance-based are almost 15 million stock options. These performance-based stock options vest at a share price level of 800 rupees a share, 1,000 rupees a share, and 1,200 rupees a share. The charge for the performance-based stock options granted has been shared separately from the charge based on the time-based stock options. The grant of the 2 million stock options that happened this quarter was of the time-based stock options, and correspondingly the charge would be close to about 80 crore rupees for the full year. So as you can see, if we were to use somewhere around, let's say, 3 million stock options a year on time-based, the 3 to 4 million, the pool would last about 6 to 8 years for us. And equally, if we were to use about 2 million performance-based stock options per year, again the pool would last an average of about 7 years.
Understood. So on average, you're giving 2 to 3 million ESOPs per year, and these are given at face value, right?
Yes, 2 to 3. I mean, I said that roughly you should assume that 3 million odd time-based stock options per year and about 2.5 to 2.5 million performance-based stock options. The performance-based stock options costing gets adjusted downward because of the probabilistic event of achieving these share prices. Yeah, and just for accounting standpoint, this cost doesn't get reversed in accounts if the price level is not met, and equally there will be no dilution corresponding to these either.
Understood. And coming to this slide 11, which is on the incremental adjusted EBITDA movement. Now, some of the costs are related to capacity expansion, but if we take out some of those, for example, DC capacity expansion was 2 crores. Then there is 13 crore increase in transport fixed cost. Some of that is mid-mile capacity investment, and some of it is business as usual increases in salary. So my point is that even if we take out some of the costs which are related to capacity expansion, then the increase in transportation service EBITDA, corresponding to the increase in transport revenue. Obviously, you have not given the breakup. First of all, if you can give the breakup. So, for example, 2 crore I can clearly take out and add back to the -6, right? But out of this 13, how much is mid-mile capacity expansion?
So, the way I think one other important part to look here is the security and extreme weather related impact. This has been estimated at a conservative level where parts of the country have been completely shut, and our estimate is that we would have lost about 500,000 to 1 million package volume in this period, and we continue to pay wages for all our staff and ensure their security. So if you were to take, just add 2 and 4, this will take it. This will make the service EBITDA impact neutral, and the mid-mile capacity expansion would have been, I think, about 8 to 9 crore out of that 13 odd crore impact here. So that would be
nice. So add another 4. So basically, on 44 crores of incremental revenue, adjusted for all these things, you have 4 crore increase in transport.
You would add 8. You would add back 2, you would add back 4 from the security impact, and you would add back 8 from the mid-mile capacity.
Okay. So then you have these increase in corporate cost also. So in this, there is only thing which is one-off seems to be this 5 crore, one-time milestone-based payment. So net, the costs are also increasing, and the increase in service EBITDA is not able to take care of at that scale that we are operating in.
This quarter.
In this quarter.
This quarter, I think the point that we've been making consistently is that we are in preparation for larger volumes going forward. I wouldn't read too much into the numbers from any single quarter.
No, but then the adjustment that we are doing was to take out those costs, right, which are arising because of the scale investment. And then after making those adjustments, then we are saying that increase in corporate cost are not able to take care of the transport service EBITDA after having made the adjustments for scale investments.
The increase in corporate costs of 6 crores in salaries is an increase linked to our annual performance. We have an incremental of 44 crores. The incremental gross profit is 17 crores, which is quite obviously visible. There are certain network investments that have been made because we expect significant incremental revenues through the rest of the year, which will come through. Our corporate costs are not expected to rise through the rest of the year. The remaining fixed costs are not expected to rise through the rest of the year.
Understood. Okay. Thank you for explaining.
Hi. We're at the end of the Q&A, so Sahil, Amit, I'll just jump in with a few questions from my side, if that's okay. So one of the things you mentioned, Sahil, in your earlier presentation also is that you've closed some of the partner constellation last mile centers, opened new express delivery centers of your own, and you mentioned that the larger partner centers were moved in-house. So I'm just wondering, is this driven by, as partner centers become larger, there's scope for deployment of automation, and you do prefer to do that in-house? Is that how I should think about it? Or is this a one-off thing, or is it a structural change in that sense?
Yes, It's a tactical thing that we keep doing on a regular basis. These are small delivery stations.
Right.
The constellation program is where, somebody in a local market can run a delivery station for us. It's not because there's scope to automate or anything of the sort. I think when volumes become large, typically there are certain processes that need to be built in, which are better done through our own delivery centers than through partner centers. Partners may continue with us. What typically happens is that you split the network. So, for example, if you're running a telecom network, as traffic in a cell site becomes larger, you split the cell site. Similarly, in logistics, when the volume in our DC becomes large enough, we split the DC. Or replace it with one of us. It's a fairly tactical and sort of routine process.
Got it. Understood, Thal. My next questions are just some housekeeping questions. So first, if you can explain what you meant, Amit, on some changes to other expenses and other income, because I noticed that the other expenses also went up QOQ. So if you can explain that, and then finally, you used to provide this cash lease rental split between interest expense and ROU. So if you can do that, and finally, the capex and FCF for the quarter, and related to that, did working capital kind of benefit from the higher share of D2C in this quarter?
So, Vijay, I won't have the capex and FCF number exactly with me, but the working capital improvement was largely driven from our B2B businesses, primarily part truckload and supply chain services. The capex and FCF numbers we will release along with our September balance sheet. Coming to your ROU question, can you, Apar, please jump to the adjusted EBITDA bridge slide? We again will not have the ROU absolute asset here because the balance sheet was not being released for quarter one.
I see.
The adjusted EBITDA walk. Yeah, so the actual rent paid for the quarter was 66 crore. While your amortization of the rentals would have been part of the depreciation and amortization. We share back this exact number along, offline with you.
Okay, sure. And yes, so just the last question, the clarification on other expenses and other income that you mentioned earlier. What exactly?
Take this up. Varun, can you please take up the adjustment between other expenses and other income adjustment?
Can you please repeat the question?
The adjustment that we have done in other expenses and other income. It is a classification. What exactly was reclassified?
Vijay, can you repeat the question, please?
Yeah, Varun, can you hear me? Hello, Varun. I think Amit, Varun can't hear us. Varun, if you can hear me now, the question.
I can hear you.
Okay. The question was, what is the reclassification that has happened between other expenses and other income? Because the other expenses look like they've gone up QOQ, right? So
the increase in other expenses is not driven by the reclassification. Some of the expenses that would have that drive this increase in other expenses are, if you see the notes that we have disclosed as part of our annual results earlier, you'll see that marketing expenses are a part of our other expenses.
Okay.
Some of the things like travel expenses are part of our other expenses, or things like the technology costs are part of our other expenses. So these technology costs would have gone up along with volumes as well as the fresh investments that we make. On that bridge slide, you would have seen that we have shown as part of our corporate cost increase that we have increased our spends on marketing starting this fiscal. So that also explains the increase in other expenses. So it's those kind of multiple items which have driven the increase in other expenses. A majority of them would be part of our corporate costs.
Got it. Thank you. Those are my questions. Thank you so much. I think we're at the end of this call now. So I'll just give this back to Sahil and team for your closing remarks.
Thanks, Vijay. Thank you all for joining the call. And as I mentioned, the summary of the quarter is, we're happy to have a fourth consecutive quarter of revenue growth. We made some investments in capacity expansion, which have marginally reduced margins, but overall economic performance of the business continues to remain stable. And I think we're pretty positive growth outlook going into quarter two and the second half of this year. And so hopefully see you all at the next earnings call in 3 months. Thank you for hosting us, City team.
Thank you. Thank you, everyone.
Thanks, everyone.